A U.S. pay stub document summarizes your earnings, taxes, and benefits in a single location. It functions as a map, tracing the exact path your money takes from your total earnings down to your final take-home pay. For many U.S. women, reviewing these lines provides the specific data needed to verify that benefits are active and taxes are being withheld according to their current filing status. This schematic outlines the foundational anatomy of the document. Every standard pay stub is divided into 4 distinct zones: your employee information, your earnings, your deductions, and your net pay. Timing is established in the first zone. The pay period represents the specific calendar days you actually worked. Employers set these schedules, which typically run on a weekly, bi-weekly, semi-monthly, or monthly cycle. The pay date is the day those funds are distributed. Notice that the pay date usually falls several days after the pay period ends, allowing time for payroll processing. Tracking this gap helps align your personal budget cycles and automatic bill payments with the actual arrival of funds in your account. This bar chart represents gross pay. This is the absolute starting point of the calculation, the total amount of money you earned during the pay period before any taxes or deductions are applied. Depending on your role, this gross number is built from multiple components. It might represent a flat portion of an annual salary or an accumulation of hourly wages, overtime, commissions, and bonuses. The gross pay number at the top of the stub is the maximum value of the paycheck before withholdings begin. Because this number is the raw material for the rest of the calculation, determining your actual disposable income requires tracing the path downward through each deduction. The first layer subtracted from your gross pay consists of statutory deductions. These are the tax withholdings required by law. As we see on this chart, a significant portion is withheld for federal income tax. Your employer sends this amount to the government based on the progressive tax code and the information you provided on your Form W-4. State and local income taxes may also be subtracted here. These rates vary by location. Some states charge a flat rate, while others collect no state income tax at all. FICA, or the Federal Insurance Contributions Act, appears as a separate mandatory category. This payroll tax is distinct from your federal income tax. FICA follows a specific percentage. It deducts 6.2% of your wages for Social Security and 1.45% for Medicare. These mandatory deductions are legal obligations that serve as contributions to the national retirement and healthcare safety net. After mandatory taxes, you may see voluntary choices. Employer benefits like health, dental, and vision insurance often allow you to pay your share of premiums directly through your paycheck, typically at a lower rate than the open market. This flowchart illustrates the difference between pre-tax and post-tax deductions. Pre-tax deductions are pulled out before taxes are calculated, reducing your taxable income. For example, moving a traditional 401k out of gross pay leaves a smaller balance for income tax. Post-tax deductions occur afterward. In contrast, a Roth 401k is a post-tax deduction. It does not lower your taxes today, but it allows for tax-free withdrawals in retirement. Regardless of which you choose, verifying your employer match helps track your total wealth-building progress. Understanding the pre-tax shield allows you to identify which choices actively lower your current tax burden. You may also see a specialized pre-tax deduction for your medical expenses, the Health Savings Account, or HSA. The HSA offers a triple tax advantage: contributions, investment growth, and withdrawals for qualified medical expenses are all tax-free. To contribute through your paycheck, you must be enrolled in an eligible high-deductible health plan. The IRS sets annual contribution limits for these accounts. For 2024, the limits are $4,150 for an individual and $8,300 for family coverage, with a $1,000 catch-up option for those 55 or older. A flexible spending account, or FSA, is another pre-tax option. Unlike the HSA, an FSA usually requires you to spend the funds by the end of the plan year. Actively managing these deductions provides a method for handling current medical costs while planning for future healthcare security. The final calculation is your net pay. This is the take-home amount that is directly deposited into your bank account. While net pay covers the current period, the column labeled YTD, or year-to-date, tracks your progress across the entire year. The year-to-date column shows the cumulative total of your earnings, tax withholdings, and retirement contributions from January 1st to the current pay date. Your net pay determines your monthly budget, while the YTD column allows you to monitor annual targets, such as retirement contribution caps. Identifying the specific lines for your earnings and withholdings provides a direct look at the flow of your income. Please note, this video is strictly for educational purposes. It is not personal financial, tax, legal, payroll, employment, insurance, retirement, or investment advice. Always consult a qualified professional regarding your specific financial situation. Reviewing your latest pay stub ensures you understand exactly how your earnings are distributed. Use this information to confirm your contributions are on track and to ensure that your tax withholdings are perfectly accurate.